Well, hello everyone, and thank you so much for joining us today. For those of you who don't know me, my name is Kate Clarke, and I am the founder of Artemis Clarke. And at Artemis Clarke, we work with growing SMEs to build brilliant finance teams, whether that's helping to recruit a senior finance leader, or providing fractional finance director support, or even delivering financial health checks to make sure that the numbers behind the business are in good shape. And we run these webinars every month to share ideas and insights that add real value for business owners and finance leaders. And today's session is all about one of my favourite topics: how to communicate your story and your numbers in a way that investors will say yes to. And I'm delighted to be joined by Camilla Greenwood, one of our fractional finance directors, and she's scrutinised countless pitch decks and really understands what investors look for. And we're going to be talking about how you can bring your story to life, what the financials should show, and how to build trust through those numbers. So Camilla, thank you so much for joining us today. You've worked with founders at so many different stages of their growth journey, and I know that our audience is really going to value your perspective on what makes a great pitch stand out. I'll let you start by giving a bit of background about yourself and sharing your experience in the investment space. So over to you, Camilla.
Thank you, Kate, for the introduction, and I am delighted to give an investor view on raising investment. I've been equity investing for almost 5 years, with check sizes ranging from £500,000 up to north of 30 million. So I've seen a lot, deploying well over £100 million. Prior to investing over 10 years ago, I started on the PwC graduate scheme and gained my chartered accountancy qualification. I spent a lot of times in financial due diligence, so kicking the tires and giving a rubber stamp on the financials in a transaction, whilst also advising on some of the key negotiation points within a deal. So I'm obviously very biased on the financials and definitely looking forward to stress this today.
Brilliant, thank you. And I guess that there are lots of reasons why a business owner could be looking for investment, whether that's expanding organically into a different region, and therefore needing more boots on the ground, or they could be launching a new product line, or maybe growing inorganically through a buy and build strategy, buying other businesses, or potentially they're towards the end of their journey as an entrepreneur, and they're looking to take some cash off the table and planning for succession and retirement. So I know that you've seen pitch decks that cover all of these different scenarios, but what do investors really want to see when they're looking at such pitches?
I totally agree. There are lots of businesses looking to raise capital for lots of different reasons, which makes it a really competitive space. More so in the venture capital world, where I would look at the pitch decks in an average week and say no to 99.9%. So that 0.1%, just getting a Teams call, is really positive. But after that, it is such a long process before the cash comes in the bank.
Yeah.
So in terms of the pitch deck, you really need to wow. And the AI and the internet make it a lot easier now to create a polished deck. Therefore, content is more important than anything. Me personally, and a lot of investors typically appraise using something called the 5 M's. If you've done business studies or economics, you might be familiar with the term. It's a well-known curriculum in appraising the business, and it enables me to give a holistic view when deciding whether something is investable. So if you're happy, I'll take them in turns, I think.
Yeah, 100%.
So number one, the most important, I might be biased here, but I think a lot of investors tend to agree with me, it's management. So the question in my mind is, or what I'm trying to get comfortable over, is this management team that we're backing, are they going to be able to take this business to the next level of growth and ensure that there's no hiccups along the way? Have they got passion and grit to get through the tough times? And it's really important to try and show examples of this. COVID's a fantastic one. The world stopped for most businesses. So being able to show, a recovery and resilience through tough times is someone that I want to get behind. You have to remember that investors have day jobs, so we don't want to have to step in and run a business. That it would definitely be a worst case scenario. So we have to be comfortable that you aren't going anywhere, and that if you are, it's discussed up front and a succession plan is in place.
Yeah.
It's ever more important with a cash out exit scenario. There needs to be another management team in place.
Yeah.
So the second one is market. So how big is that market that you sit within, and is it growing? Do you need to take market share from someone else? And if so, what makes you better than them? And how do I verify this in diligence? Number 3, momentum. Is revenue growing? Are you winning new customers? Are they spending more? It's typically a red flag to invest in a business going backwards. And once you're through the negotiation points and well in the weeds of diligence, which is a headache, I'm sure, you have to remember you still have the day job and you still have numbers to hit. So it's an incredibly hard time for founders. But we would see a business going backwards as a red flag. So I'd say definitely spend a little bit more time and effort in those numbers during the diligence process. So we've done management, we've done market, we've done momentum. The 4th M is model. So what is your business model and how sustainable is your revenue? Lots of investors have different preferences. Some may prefer a recurring revenue business, which usually delivers a higher valuation. Sometimes it might be an operational leverage play, and as you grow revenues, your EBITDA or profit may improve. How is cash collected? What is the operating cash flow? An investor may want to take on debt later. So how do they get this cash out? Then finally, last but not least, money. How does the business make money? How do the financials and KPIs benchmark to successful businesses in similar sectors? Are there any liabilities within the business that may affect an investment? Returns and exit are super, super important. I know it seems funny to think about exiting on before you've even invested, but an investor wants to know that it can get its money back with a commercial return. So having an idea of that on day one is super important. And also who you might sell it to.
Sell it to, yeah. No, 100%. No, I was just, sorry to interrupt there. I was just going to say, like, I've done sort of a small amount of angel investing myself, and you know, if someone presents and they haven't given any thought to that exit strategy, then it is a little bit of a red flag. You know, you want people to be passionate about the growth, but ultimately they do need to think about it, because as an investor, you do want to get your return on your capital.
Exactly.
No, that's brilliant. So the 5 M's then. So the management, market, momentum, model, and money. That sounds pretty simple, Camilla. You make it very straightforward. So but you know, if everyone's using that framework, how can a business owner then really stand out?
It sounds simple. I think the best thing to do is condense all of those 5 M's into really succinct, clear and concise messaging throughout, and making sure that the messaging is the same throughout.
Okay.
If the answers aren't jumping off the page, I'm most likely to move on to the next step. And if I can't understand the story, what the business does, the problem statement within a few minutes, I'll lose desire to continue reading. It's very brutal, but definitely fact. There's a lot of technical businesses out there, and especially in the venture world. And if you can't articulate what it is to, say, your mother-in-law, your toddler, then it makes it really hard for someone else to understand and do the correct diligence, etc. So super important.
No, I do notice actually when we've got, you know, university spin-offs, and I quite often think that when they do the presentations, there is a lot of technical jargon in there that they assume is common knowledge. So maybe this is a really good use of ChatGPT, and like put it in there and sort of say, you know, can you actually then turn that into something that, you know, a 10-year-old would understand? So yeah, because people think that, investors have, knowledge of all the different industries and all the acronyms associated with it. So no, I think it's a really good point. Yeah, and something else I must admit, I'm quite a sucker for sort of a bit of a backstory when a founder presents. How important is that? Is that fluff, or is storytelling important?
There's a balance. I think it's definitely important to have that story to be able to articulate why you want the investment, how you're going to scale, how you've got to where you are today, and why you deserve, or why you're backable to have that investment. But it needs to be based up with facts. So investors are naturally cautious. They're dealing with significant amounts of money, and there's a lot of risk on the table. And a lot of successful CEOs have had a fantastic career selling their services and products, etc. So the investors may feel it's a bit prickly when you're making wild statements. For example, we are the market leader. Okay, what's your market share? Why are you better? Who are you displacing? Is there enough room for you to achieve those numbers in your financial plan? Will your customers back this up in time when we go and speak to them? Do your financials marry up, i.e. there's no churn? So I think the story is very, very important, but back it up with facts, and wild statements definitely need some sort of robust numbers behind them.
Yeah, no, 100%. And when someone says market leader, would you expect them to have at least 50% share of the market? Is that kind of what you would be looking at?
Yeah, definitely 30 plus, I would say.
Okay, interesting. And obviously we've spoken about sort of you working with like a sort of a number of different businesses, as do Artemis Clarke, of different shapes, sizes, sectors, life cycles, etc. And they all need, as we've discussed before, that investment for sort of different requirements. So, in terms of looking at your investor, should you be looking at, different people for different needs? I imagine one size doesn't quite fit all.
Correct. Lots and lots of investors out there, and they all have different preferred playbooks, different preference of stage of business, check size, exit strategy. So, for example, venture capital in the earlier stages of businesses probably prefer the deep tech, fast growing tech, whereas a manufacturing business may benefit from a regional fund investor that understands customers and the regional, your supply chain within the region.
Yeah.
A family office may want a more stable business that pays dividends and isn't looking to exit until, well, may never exit. Whereas a 2x return may be palatable there, whereas VC may want 5x plus.
Return, yeah.
And I know it's overwhelming with all the investors out there, and ChatGPT will probably come up with a fantastic list, but I'd say choose 10, go and have a look on LinkedIn at the investors there, look at what they tend to invest in to see if it's similar to your business, and then also whether they'll culturally be a good fit. So other stuff.
Yeah. And I guess I remember sort of a while ago someone sort of saying to me that actually going and talking to investors before you're actually ready for that investment, to start sort of engaging with them and almost sort of telling them what you plan on doing, so that when you then come back in 2 years' time and you've done what you said you were going to do, then actually that can be a really strong thing to do. Would you agree with that?
100% agree. Both firms where I worked had an origination team, so they would go out and meet businesses day in, day out, and that's a perfect way of articulating to them your business, the profile for investment. We want to invest in 2 years. Please ask within your team what good looks like, or what I need to be doing to get there, and maybe developing a deck with that in mind, being quite upfront. We're not looking to raise right now, but this is us. This is where we plan to be in 2 years, and we want to start having those conversations early.
And you've sort of at the start alluded to the fact, it's a very competitive space. You get like loads of pitch decks. Just sending a LinkedIn message or an email probably is quite difficult. Would you suggest like other avenues, like potentially trying to sort of attend, that free events that some of these like VC businesses, run? And if
Yeah.
so, how should people go about doing that?
So I'd choose your top 10. I would follow them on LinkedIn, and then you'll hear about events they're doing. And a lot of businesses will do events,
Hmm.
and attend them. There's obviously market events as well. So if you look on Business Cloud, Insider, The Pitch, things like this, you sign up to those events and maybe ask ChatGPT for your regional, local events. And
Hmm.
it's just getting your name out there, speaking to people. Whilst the partners or the directors might not be at the events and it might be more junior people, it's still a fantastic place to showcase your business and have those earlier discussions.
Yeah, no, 100%. And I guess also thinking about it, like some of the growth programs that I've been on, and it's sort of there's the NatWest Accelerator, it was eSpark, but now called the NatWest Accelerator, sort of getting involved in those and then doing pitches there. You might have then investors coming along to that and being able to have conversations there as well, I guess.
100%.
Yeah, but
You've got your lawyers as well and accounting
yeah,
firms. There's lots of big players out there that all, if you think who touches the deal, who would know about intros and to the investors, and then thinking more broadly that way.
yeah, okay. And what happens if the alignment isn't there? Hopefully you realize before it's too late. But yeah, what's I'm sure you've seen this on many occasions.
It happens. Yeah, humans are unique in their own right, and sometimes the fit's not there. But I would definitely walk away or well run away. Misalignment early on causes lots and lots of tension, and you're looking to partner with someone for 5 years plus probably. If you're
Mm,
not cashing out now, the next investor may expect you to roll a significant amount to show that you believe in your business, for that next stage of growth. So that could take you to 7-10 years, so you have
yeah,
to make sure that you're aligned. It's not just money either. A lot of investors offer more. So my prior firm, we called it more than money. So there's operational partners that come and sit on the board that have had proper jobs, scaled proper businesses, to FTSE standard status, sorry. So yeah, ask what more can you give me than the money, because that might set certain investors apart.
yeah, yeah. No, that makes sense. And yeah, obviously we both have a sort of a strong financial background, so we're a little bit biased here, but I think I know the answer. But how important would you say that the financials are in the pitch?
Very, very, very important. Generally speaking, at the earliest stage, there's less focus on the financial plan. It's
Mhm.
probably cash runway. What does the next 2 years look like? Is this business going to run out of money, and when does it need more money? But if you've been established for 2-3 years, then yeah, how your historical numbers tie to your forward-looking numbers is super important, because I'm biased obviously, but they're the bedrock of an organization. You can understand a lot within the numbers, and it talks to the story that you're presenting.
Yeah, no, 100%. And I think you've got sort of an example of this, what you would put in your slide deck in terms of sort of the finances, haven't you? I don't know if you're able to
Yes,
bring that up and share.
just finding it now.
Yeah,
I hope you
very
can
cool.
see that.
Yeah, yeah,
Yeah,
absolutely.
perfect. So here's what I made earlier. This is typically what I would see in the first average pitch deck. As you progress, you may have a separate financial, heavily focused workbook or pitch deck, but this is a good start. So
Hmm.
it's easily digestible on the left here. You can see revenue's been flat for 2 years, but this year it's set to grow. Profit seems to be pretty flat until year 3 onwards. These blocks at the bottom really highlight some positives. So whilst it might look flat here, it's saying that it's actually growing 15%. Gross profit has also improved. So I obviously, my first assumption here that it was flat was incorrect, but I've brought it out here. And then a little bit on cash burn because it's so important. And then the narrative here should hopefully talk to these numbers. So it's saying here that the growth is due to a new production line, and that's what's going to drive operational leverage going forward. And the money, the investment request is to open a third manufacturing line. So have they got a proven track record of opening new lines? Yes. Has revenue grown? Yes, it's an outturn number, which we'd want to diligence, but yes, they have proven, subject to the next 6 months obviously delivering, that they've been able to do it before. So it's a big tick from an investment standpoint. And then the returns, well, I can see here quite easily that I should make returns to my investor if this number times a multiple, well, this number times a multiple will be significantly higher than this number times a multiple. So hopefully it will deliver strong returns.
Yeah, no, brilliant. And I guess sort of behind it, even though it's, it's a very simple slide that you're suggesting having in the initial pitch deck, and that you might share the workbook later, I'm assuming that even to put this slide together, you should have like that sort of three-way financial model supporting those numbers. Is that fair to say?
Yes, 100%. Kate, you won't believe how many people don't have a three-statement model.
Yeah.
And how can you correctly budget your next 3, 6, 12 months without that? It needs to be quite dynamic, built up, bottom up. I've seen quite dynamic revenue numbers and the rest falls into place, which is okay. But yeah, if sales drop by 20%, what does that mean to your bottom line? As a CEO, a CFO, we've seen what happened in COVID. You want to know what that means to the bottom line and viability, etc. So yeah, super important. There should be backing behind here, and then should you progress conversations with an investor, typically it would be share that financial model in the next meeting, and maybe follow up with a little workbook that's a bit more advanced than this, highlighting what the key drivers are so that an investor can sensitize it. What happens if that production line generates half the amount of widgets? What happens if it takes 6 months to get there? It's all these scenarios that an investor would want to diligence and give themselves comfort.
So when you say drivers, you kind of like talking about sort of the assumptions that you would have on your sort of assumptions tab that you would then, as you say, sort of change those to then see how that then impacts the model, I guess.
Yes, so typically we'd see color-coded input cells where I can tweak a 20 to 10%, etc., and it'll flow through. But yeah, super important.
Yeah. And what would you say the red flags are when you look at sort of a slide like this?
If there's no financial model.
And she takes it down, whips it away.
What are the red flags? So trends that you can't explain, so revenue growing drastically but margins dropping away. So are you winning work by undercutting everyone else? That doesn't sound very sustainable. The list is long, but anything wildly different that can't be supported by the narrative earlier on.
Yeah, I mean, because quite often you sort of see revenue forecasts that, like, let's say the business has been going sort of 2-3 years, and like, maybe they've had like 10 or if they're lucky 20% sort of increase year on year, and then suddenly they're like sort of doubling in size. I imagine that would be something that you kind of, I mean, these things do happen, especially in tech businesses, but I guess you've got to then have that plan behind how you think that growth is going to come, and then maybe a track record of, proving that you do the X of this activity and then you get Y return, and then multiplying that up. So yeah, okay.
One thing I would be cautious about is, yes, investors love an ambitious plan, but if you don't deliver it for whatever reason and the investment process delays, it makes you look like you lack credibility. If you so just apply a little bit of caution there.
Yeah, okay. No, that makes sense. And what would you say, because we talk a lot about KPIs, what would you say the KPIs are that matter most to investors?
What matters most? So I think your revenue year-on-year growth, your gross profit margin, EBITDA margin or net profit margin, operating cash flow, that they are standard, and I think everyone should be able to articulate those.
Mm-hmm.
Depending on the sector and business model of the business, then there's another sort of layer of KPIs. So SaaS businesses or recurring revenue, you'd want to have that MMR bridge, monthly recurring revenue bridge, or ARR, annual recurring revenue bridge.
Yep.
Customer acquisition costs. So I'm having to pay to acquire a customer. Does it make sense to do that? How much am I spending on marketing, etc.? Is the ROI there? What's the lifetime value of these customers? What's my churn rate? Then for a manufacturing business, unit economics, production efficiency, inventory turnover, service-based firms, so people businesses, utilization rates, client retention, revenue per client. The list is endless, and I'm sure if you Google your sector, there'll be widely acceptable ones, and make sure that you reference that. So for SaaS businesses, there are standard numbers. For example, a churn greater than 10 is sort of a red flag, and they have something called the rule of 40. So it's making sure that you benchmark okay against what the market sees as good.
No, that makes sense. Yeah, I did. It came and it went, and it's gone again. It's come back again now. I was going to say that again. Something else that someone once told me with KPIs is, actually, the best ones are the ones that you can get quite readily from your financial information or from your operating system, not ones that sort of take days to produce. It's that kind of what you would sort of expect.
100%. This should be embedded in the business, and you run the business, you know the business better than an investor. So, it might be that a churn rate is just irrelevant. And whilst it's a SaaS business, you might have a good reason for it. And by all means, articulate that to investor and have a response for what you use already. Articulate what you use as a first, as a rule of thumb.
Yeah. And I guess any other sort of red flags when it comes to KPIs? You sort of touched on them when we sort of were talking about like just the finances in general, but
again, that rapid revenue growth and collapsing margins, rising customer acquisition costs. People are spending a lot on marketing at the minute, digital marketing. So if Google ad spend is going up drastically, you want to see that ROI. Otherwise, you need to come up with a better marketing strategy. Cash burn that isn't matching the funding runway. There's lots and lots out there. I think red flags would be not having any.
No, that makes sense. I'm conscious of time, and I wanted to keep this to ideally half an hour. So, but before we finish, could you give some like sort of final words of wisdom for any founders that are preparing to raise their first investment?
Of course, I think having an eye on valuation, so thinking about what your business is worth and being realistic and reasonable with it. So it's super emotive, and it is a tricky one. So get advice, look online at similar businesses that have been sold recently. A day one big prize might be fantastic and ego boosting, but it doesn't necessarily mean a big amount of cash in the bank. So put the ego aside, do the maths. You don't want down rounds later on. So typically people looking to scale, they don't just take on one investment round, they take on future ones, and making sure that your valuation ticks upwards is a green flag. It's a positive sign.
Yeah, I hadn't realised the importance of that actually until joining, becoming a sort of an angel investor and realising that, if they've done a first round and it's valued at a certain amount and then they come back for more money, but at that point the valuation of the business has gone down, hence what you said, like the down round, then actually
Yeah,
that is perceived to be like sort of quite a negative thing. So and it does make
yeah.
it then tricky, doesn't it, to raise further investment.
Obviously, you don't want to give away lots and lots of equity on day one, so having a higher valuation ensures you don't. But
Hmm.
I would try and structure something a little bit different and push your advisors for this. So maybe a ratchet, growth shares, something else that creates value, but without giving away loads of shares on day one. Yeah, I love a complicated deal structure.
Who's the best person to advise on deal structures?
I would go to your investors, ask a few. Lawyers probably see a few and obviously are unbiased, or your accountancy practice advisors there.
Hmm.
There's lots and lots out there, and I wouldn't be afraid to push back on an investor and say, what does this mean? Can you give me a spreadsheet that shows me what cash I get in the bank? Because the
Yeah.
terms years ago, and I was very new to this, they're overwhelming. There's so much out there, and lots of different preferences with shares. And whilst you might get a lovely big enterprise value, your headline price, it might not equate to loads of money in 5-10 years time if the investor has a preferred structure and might demand 3 times return before you share in the returns waterfall. So just be mindful of that.
Okay.
And again, ChatGPT probably will give some good advice on that. Ask for the terms with investors, digest it, use ChatGPT, ring me, and you'll get there.
Yeah. No, 100%. And I guess, yeah, what you're saying about that sort of spreadsheet, sort of maybe doing like your own sort of scenario analysis in terms of like, the different, growth rates of the business, and what does that then look like in terms of the return, and actually put some numbers down and do different sort of, upsides, downsides, etc. And then that will make sure that you fully understand what the deal structure looks like.
Yeah.
Yeah,
Whilst we're
no,
on
that's
deal
good.
structuring, one other thing is keeping the cap table clean. So whilst lots and lots of angel investment is good, it can be quite administrative later down the line if their rights are all pari passu. So just be mindful of that later down the line. Make sure you can buy them out later. And I think I touched on this
Yeah.
earlier, but on the dilution point, make sure you keep as much equity as you can. There are other debt instruments that look like equity, but actually are debt, that could be used
Hmm.
instead, because you need to keep some equity aside for other people within the business that need to come in and help you with that next stage of growth. You may want to expand into America, and to incentivize someone, you might have to give away 5% of equity, but owning 70% of something bigger beats 100% of something
Yeah.
smaller, if that makes sense.
Yeah, yeah. So you can have shares, can't you, that have been sort of specifically allocated for future use.
Yeah, deferred shares.
Yeah,
There's
yeah,
all
yeah.
sorts out there, and I think you have to ask the questions with your advisors to see
Find
what
out.
fits
Yeah,
you, and
yeah,
don't be
yeah.
afraid to negotiate.
Yeah, yeah. Okay, well, that's brilliant. And I think you put together a nice sort of summary PDF that if anyone today, well, anyone watching it on the replay on LinkedIn as well, if you want Camilla to send that to you, then just feel free to reach out to her or to me, and then we can send that over. But no, it's been a brilliant session. Thank you so much, Camilla. I think hopefully we've covered loads of really interesting points for anyone preparing for investment. And thank you to all of you who've joined us today. I hope you've taken away some practical ideas. that will help you strengthen your next pitch and make you feel more confident about your numbers. So yeah, if you also, I should mention, if you'd like to catch up on any of our previous sessions, we've been doing these webinars now for over a year. They're quite difficult to find on LinkedIn, but we've now got them on our YouTube channel. And yeah, if you go to my LinkedIn page, you can also find in the events section, which, as I say, is tricky to find. It's within posts, but yeah, you can catch up on any of them. So no, thank you so much for your time, Camilla. Really enjoyed it, and thank you for everyone joining us, and hope to see you next time. Take care.